Imagine, just for a second, walking out of your office for the absolute final time after 3 decades.
Oh man, 30 years. That is a lifetime in the corporate world.
It really is, right? I mean, you've weathered multiple severe economic crashes, navigated this insane global pandemic that totally shattered supply chains, watched your whole industry basically digitize, and you led the charge through all of it.
Right. Yeah. You've seen everything at that point.
Exactly. And usually, when that final day finally arrives, there is a certain predictable script that executives follow.
Yeah. The quiet, nostalgic farewell tour.
Right. You expect this gentle coasting toward retirement. The narrative naturally shifts entirely to the past, like looking backward at what was built over those 30 years.
And no sudden movements, It's the standard playbook. You just hand over the keys without upsetting the market or the incoming leadership team.
But that is not what happened here. I mean, the outgoing CEO did not coast at all. Instead, he dropped this financial report that honestly forces us to completely reevaluate the growth ceiling for mature industrial companies.
He really went out with a bang.
He absolutely did. So welcome to this Talk Tickers deep dive. Today, we are opening up the Q2 2026 earnings call for Fastenal Company, ticker symbol FAST.
We've got a massive stack of sources for you today, too.
Yeah, we pulled everything. We've got the raw earnings call transcript, their latest 10Q filing, a solid decade of historical financial data, and quite a few conflicting Wall Street analyst notes to sift through.
The mission today is really to synthesize all of this noise and figure out the actual underlying mechanics of this business.
And the hook here is the historical context, like we mentioned.
Yeah.
This was the 121st and final earnings call for Dan Flournese.
121 calls. Wow.
Right. He joined the company back in 1996, served as CFO, then CEO, and has just been the operational architect for 30 years.
But what really stands out in the transcript, is the deliberate rejection of all that nostalgia.
Yeah, they did not linger on it at all.
No, not even a little. The incoming CEO, Jeff Watts, he took maybe 60 seconds to honor that 30-year legacy. He acknowledged the candor and financial discipline Flournese instilled, and then bam.
Just straight to business.
Exactly. He explicitly stated, this is not a farewell speech, it's an earnings call. And the underlying data from this quarter requires immediate, rigorous analysis.
I honestly appreciate that level of pragmatism because we are here to translate that data into plain, actionable language for you, the retail investor listening to this.
Right. We need to figure out what this leadership transition and these wild financial metrics actually mean for your portfolio.
Whether you already hold Fastenal or, maybe you're just evaluating where to deploy some capital right now.
So the central thesis you really need to keep in mind as we parse these documents today is that Fastenal is basically functioning as an incredibly optimized cash generator right now.
An absolute cash machine.
Yeah, they are aggressively capturing market share in an industrial manufacturing environment that is honestly sluggish at best right now.
Yeah, the macro environment is not exactly booming.
Exactly. So our goal today is to cut through the immediate Wall Street noise, specifically all this intense scrutiny around their gross margin contraction, and show you exactly why the core engine of this business is actually accelerating.
Well, let's pull the headline numbers from the data stack because the top line growth is just highly anomalous for a company of this age and scale.
It really is.
So get this. Fastenal's Q2 daily sales grew 14.7%.
Which is huge.
It is. And to contextualize that, it actually represents a clear acceleration from Q1, where they posted 12.4% growth. But the data point that totally jumped off the page for me was the month of June.
Oh, the June numbers were wild.
If you isolate just June, their sales jumped an incredible 20% year over year.
Yeah, that 20% figure in June, that is a critical signal. I mean, when an established, heavily capitalized industrial distributor suddenly accelerates to a 20% growth rate in a single month.
It's not just normal macro tailwinds at that point.
No, not at all. It indicates a structural shift in their competitive positioning. They are actively displacing competitors right now.
And that top-line surge translates directly down to the operating profit, right?
Absolutely. Operating earnings grew by $65.7 million. That is a 33% increase over the exact same quarter last year.
Which is crazy. Flournese actually mentioned on the call, like a funny little side note, that he calculated that specific dollar growth on his phone calculator that morning.
Yeah, it's a super relatable anecdote. But it really underscores the sheer volume of capital flowing through their network right now.
Right. But, Wall Street algorithms and the short-term analysts, they rarely celebrate without finding something to penalize.
Oh, they always find something to nitpick.
Always.
Yeah.
Looking at the analyst notes in our source stack, the skepticism fell squarely on the gross margins.
Yeah, margins are just the eternal battleground in the distribution sector.
So what happened there exactly?
Well, the headline metric that triggered some algorithmic sell-offs is that Fastenal's gross margin contracted by 75 basis points year over year.
Okay, so it dropped a bit.
Right. And management attributed about 40 basis points of that drop to a persistent price-cost headwind.
Meaning inflation, basically.
Exactly. In tangible terms, the inflation they're experiencing on purchasing the raw goods is still outpacing the price increases they are comfortable passing along to their end customers.
Okay, I have to pause and push back on this because honestly, it sounds like fuzzy math to me.
How so?
Well, if Fastenal is making less profit on the actual individual items they sell, which is the textbook definition of gross margin contraction, how are they walking away with a 33% increase in operating earnings?
It seems like a contradiction, I know.
Right. How can they be making fewer pennies per heavy-duty bolt or like less per safety harness and still end up with a significantly higher operating profit at the end of the quarter?
It sounds totally paradoxical on the surface, but it is actually the defining characteristic of a successfully scaled logistics network.
Okay, walk me through it.
The mechanism driving this is SG&A leverage.
Selling general and administrative expenses.
Exactly. SG&A represents the structural cost of running the machine, right? It's the warehouses, the payroll, the truck maintenance, the software infrastructure.
The overhead.
Yes, the overhead. And what Fastenal achieved this quarter is structurally really difficult. They compressed their SG&A expenses down to 23.5% of sales compared to 24.4% in the same quarter last year.
Wait, that is nearly a full percentage point of operational cost savings.
It is. And the math of that is staggering because when your top line sales are expanding at nearly 15%, but you are holding the line on your structural operating costs, you create immense operating leverage.
Oh, I see. So the top is growing way faster than the middle.
Exactly. Yes, they sacrificed 75 basis points of profit on the physical items themselves, but because they squeezed roughly 90 basis points of efficiency out of their operational overhead, the net result was an improvement in their operating margin by 5 basis points.
So they effectively neutralized the inflationary pressures and pricing headwinds entirely through internal operational discipline.
You nailed it.
Wow, that is like the ultimate strategic maneuver in corporate finance. You absorb the inflationary blow on the product cost so your customer stays happy and loyal, but you engineer your own internal systems so efficiently that you still keep a larger slice of the total revenue pie.
And that specific engineering is reflected in what is arguably the most critical metric for assessing long-term corporate health.
Return on invested capital, ROIC.
Exactly. Fastenal's ROIC just hit a decade-plus high. It climbed 180 basis points on a trailing 12-month basis to reach the low 30s.
I really want to spend some time unpacking ROIC because I feel like it is frequently misunderstood by retail investors.
Oh, constantly.
And Flournese offered a fascinating historical retrospective on the call about this exact metric. Can you walk us through the actual mechanism of ROIC? Like, what does it practically mean for a company like Fastenal to hit the low 30s?
Yeah, absolutely. Think of ROIC as the internal interest rate a company earns on the cash it reinvests into its own operations.
Okay, so money they plug back into the business.
Right. If Fastenal decides to build a new $10 million regional distribution hub, an ROIC of 30% means that specific hub generates $3 million in pure operating profit every single year.
Wow. And most publicly traded companies are thrilled to achieve, what, like a 10% or 12% return on their capital?
Exactly. 10 to 12% is usually considered pretty solid. Hitting 30% means the business model is highly insulated and incredibly capital light relative to the cash it generates.
Which makes Flournese's history lesson so relevant here. Because he noted that in the late 1980s, shortly after their IPO, their ROIC was also sitting in the low 30s.
Right.
But as they expanded aggressively through the 1990s and 2000s, that metric decayed down into the mid-20s.
Yeah, and the reason for that drop is really important. It's because their business model became vastly more complex.
They stopped just selling fasteners, right?
Yeah, they became a broadline industrial supplier. They began importing goods directly from overseas, and that meant they had millions of dollars in cash tied up in inventory that was just slowly crossing the ocean on cargo ships.
Plus, they had to construct this massive, sprawling, capital-intensive logistical footprint to serve all of North America.
Exactly. This perfectly illustrates the tension between growth and capital efficiency. For a whole decade, they accepted that lower ROIC as the necessary price of building their infrastructure.
But over the last 10 years, they have systematically optimized that infrastructure.
Yep. And they integrated new inventory technologies, tightened up their supply chains, and essentially figured out how to push vastly more volume through the exact same physical footprint.
So when a company can grow its top line by 15% while simultaneously driving its return on invested capital back up to a historical peak,
it proves they're engineering highly profitable growth, not just buying top-line revenue at the expense of shareholder returns.
Okay, so if the numbers tell us what is happening, we need to look at the operational transcript to understand how it's happening on the ground.
Right, the actual strategy.
Management pointed to a specific data subset that I honestly think serves as the skeleton key for this entire quarter. They noted that customer sites spending $50,000 or more per month grew by 16.5% year over year.
That is a massive jump for large accounts.
And it gets better. The revenue generated specifically from those high-spend sites grew by over 26%.
Yeah, industry analysts refer to this as the key account strategy, sometimes called the big fish strategy.
It's the deliberate targeting of highly complex strategic accounts, right? Like heavy manufacturing plants, large-scale commercial construction, aerospace facilities.
Exactly. These are massive organizations with immense daily supply needs.
Man, landing these giant accounts explains the margin trade-off we were discussing earlier.
Completely. Think about it. When a customer commits to spending $100,000 or like $500,000 a month, they wield significant negotiating power.
Oh, for sure. They're definitely demanding steep volume discounts on the unit price of the inventory.
Right. And Fastenal agrees to those terms, which mathematically compresses their gross margin.
Okay, the intuitive analogy here for everyone listening is Costco. Let's look at the actual mechanism of why that works, because it's brilliant.
Yeah, the Costco model is the perfect parallel.
At Costco, they accept a razor-thin margin on a flat-screen TV or a giant bulk pallet of paper towels because your cart size is enormous. The sheer velocity of cash moving through the register easily compensates for the low profitability on each individual unit.
And Fastenal is basically applying that exact volume discount model to the industrial sector.
Right. They willingly trade a few points of margin on a crate of specialized bolts in exchange for, monopolizing the entire monthly supply budget of a massive Boeing or Caterpillar facility.
But, the Costco analogy highlights the volume side, but Fastenal's model actually relies on a secondary mechanism too, fixed cost absorption.
Tell me more about that.
Once one of these massive key accounts is integrated into Fastenal's localized network, the marginal cost to service them practically plummets.
Because the local branch facility is already leased?
Right. Exactly. The local manager's salary is already paid. The delivery truck is already running its daily route down that highway.
Oh, I see. So if you double the volume of safety equipment going to a specific factory that is already on that route,
you do not need to lease a second branch or buy a second truck. The influx of revenue completely overwhelms the static fixed costs.
That is the engine behind the SG&A leverage we were talking about.
Yes. As their CFO, Max Tunnicliffe, explicitly stated on the call, these larger customers generate highly attractive incremental profit dollars, completely regardless of the gross margin percentage.
Wow, that makes total sense. Now, you mentioned the delivery trucks just now, which actually brings us to one of the most fascinating operational details they revealed on the call.
Oh, the private fleet.
Yes. Fastenal operates a closed-loop logistics network. They do not rely heavily on commercial carriers to move their inventory.
Which is super rare for a distributor of this size.
It is. Flournese highlighted their distribution center in Winona, Minnesota. He noted that from that single hub, they dispatch 25 to 30 dedicated routes every single day.
Just from Winona.
Just from Winona. Across the Midwest, out of that one hub, they are driving 95,000 miles a week in their own private fleet.
I mean, think of this private fleet as a dedicated circulatory system.
Okay, I like that metaphor.
From a purely accounting perspective, it does introduce some volatility. A fully loaded semi-truck averages, roughly 7 miles per gallon?
Yeah, something like that. It's not great.
So when global diesel prices surge, Fastenal directly absorbs that commodity shock. And they actually cited that as one of the minor pressures on their SG&A this quarter.
But the strategic advantage of owning that circulatory system has to far outweigh the fuel cost, right?
Oh, by a mile.
Yeah.
Because the alternative is relying on a shared logistical network.
Meaning the major parcel carriers.
Yeah.
UPS, FedEx, whatever.
Exactly. The majority of their competitors rely on those shared networks. And when fuel prices rise, those third-party carriers implement aggressive fuel surcharges anyway. Plus, they optimize their own routes, which often degrades delivery times for the customer.
So Fastenal pays for the diesel, but their absolute cost to move a pallet of goods remains significantly lower than a third-party courier rate.
Yes. But more importantly, they control the latency and the reliability.
I really want to focus on that word, latency. Because if you were running a heavy manufacturing plant, an assembly line stoppage costs, what, tens of thousands of dollars per minute?
At least. It is disastrous.
So if you need a specific replacement valve to get the line moving again, you cannot rely on a shared cloud logistics provider who might delay the shipment just to optimize their own load capacity.
You need a dedicated server, basically.
Exactly. Fastenal's private fleet is that dedicated server. They guarantee the delivery schedule because they own the truck, they employ the driver, and they own the route.
And that reliability creates an incredibly powerful economic moat.
Right. The customer is willing to tolerate some price adjustments, or they'll stick with Fastenal over a slightly cheaper competitor, purely for the risk mitigation.
Because a cheaper bolt isn't worth a factory shutdown. And Fastenal is deepening that moat even further by physically embedding their technology onto the customer's factory floor.
This is the tech angle. We need to look at their digital footprint. It now accounts for 61.6% of their total sales. And specifically, FMI Fastenal Managed Inventory, which represents 44.6% of total sales.
Yeah, let's break down the mechanics of FMI because this is not just some e-commerce web portal.
No, this is physical hardware integrated right into the client's operations. FMI consists of industrial vending machines and IoT-enabled smart bins installed directly on the factory floor.
The mechanism is just brilliant in its simplicity. Imagine a machinist needs a fresh drill bit, right?
Okay, I'm picturing it.
Historically, instead of walking to a central supply closet, filling out a paper requisition form, and waiting for a manager to approve it.
Which wastes so much time.
Exactly. Now they just walk to a vending machine right there on the floor, swipe their employee badge, and dispense the tool instantly.
And the machine logs it automatically.
Yep. It instantly logs the transaction via API to Fastenal's central software, updates the local branch's inventory, and automatically queues the replacement item onto the very next day's truck route.
That is incredible. It also addresses a massive psychological inefficiency in manufacturing, which is tool hoarding.
Oh, absolutely.
When workers fear a tool might run out and halt their productivity, they stash extras in their personal toolboxes.
Which creates phantom inventory shortages.
Exactly. It forces the company to overorder supplies they actually already have. But these vending machines enforce accountability while simultaneously ensuring zero friction for the worker.
It creates a perfect just-in-time inventory mode. And the switching costs for the customer become astronomical.
Right, because think about it. If a factory manager wants to switch to a competing distributor just to save like 2% on consumable supplies,
they have to rip out dozens of Fastenal vending machines.
Yes, rip them out, retrain their entire workforce on a totally new requisition system, and rebuild all their inventory API integrations from scratch.
No one is going to do that for a 2% savings. The incoming CEO, Jeff Watts, framed this perfectly. He described every newly installed FMI device as a leading indicator.
A leading indicator for what?
It is a physical deposit, guaranteeing future automated orders, long-term customer retention, and the operational efficiency that fuels all that operating leverage we discussed.
Okay, so if the domestic moat is that heavily fortified by these localized trucking routes and smart pins, the immediate question for the incoming CEO, Jeff Watts, is whether he can replicate that circulatory system globally.
Right, taking it international.
Because this leadership transition is the true focal point of the management guidance section. Flournese steps down and Watts, the former president and chief sales officer, takes control. What is the strategic directive under Watts going forward?
The crucial takeaway from Watts' commentary is continuity. He explicitly confirmed that the 3 core strategic pillars remain completely untouched.
Which are?
Increasing sales effectiveness, enhancing technology services, and expanding the addressable market. He also said the decentralized decision-making structure and the culture of promoting from within are totally non-negotiable.
He did, however, emphasize a distinct shift in operational velocity. The strategy itself is unchanged, but the targeted speed of execution is significantly increasing.
Yeah, that acceleration is primarily focused on international markets. Watts highlighted surging demand from their multinational customer base.
So if a massive manufacturer has standardized on Fastenal's FMI platform in, say, their Ohio facility,
they want that exact same just-in-time reliability in their plants in Germany and Mexico.
Right. which makes sense. But currently, a unified global supply platform of that caliber does not broadly exist in the industrial sector.
Right, and Fastenal is attempting to pioneer it.
Which introduces a highly debated topic from the Q&A session, M&A, mergers and acquisitions.
Oh, this was a spicy part of the call.
It was. Fastenal has historically been a very conservative, organic growth engine. But Watts basically suggested that relying purely on organic growth to build out European or Asian supply chains might take a decade.
Yeah, and the market wants that speed now. So they are evaluating acquiring existing international logistical footprints to compress that timeline down to like 2 or 4 years.
There is inherent risk in that approach, though.
Massive risk. Integrating foreign acquisitions often dilutes ROIC and introduces massive cultural friction.
Yeah, I mean, buying a European distributor means inheriting their legacy software, their warehouse leases, their local labor contract.
Exactly. And Fastenal's entire competitive advantage relies on a highly standardized proprietary circulatory system.
So integrating an acquired network without breaking that delicate efficiency will really be Watts' defining challenge.
Absolutely. And building or buying that infrastructure requires immense capital deployment.
Right, let's look at their capital expenditure guidance because this ties right in. The projected CapEx for the year is $320 million, which equates to roughly 3.5% of their projected sales.
And the CFO provided some good context here. He noted that their 5-year historical average was around 2.5% of sales, though it was closer to 4% in the decade prior to that.
So industrial companies operate in these cyclical investment phases. Fastenal is currently in an elevated investment phase, pushing toward the upper boundary of their historical range.
Right, but the critical analysis here involves tracing exactly where those capital dollars are flowing.
They aren't just funding administrative bloat, right?
Not at all. That $320 million is targeted directly at structural growth. They are expanding regional hub capacity, automating distribution centers, upgrading IT architecture, and manufacturing more of those FMI vending devices to capture new factory floors.
They are essentially harvesting the staggering $266 million in operating cash they generated just in Q2 alone, and immediately injecting it back into the mechanisms that create the SG&A leverage.
It's a beautiful flywheel.
It really is. Now, looking forward, how is management forecasting the margin environment for the back half of the year?
Well, they adopted a highly pragmatic stance on the lingering inflation. They conceded that the 40 basis point price cost headwind will likely not be entirely neutralized by year end.
Really? So they aren't going to just force price hikes onto their customers?
No, they explicitly refuse to aggressively force price hikes onto their key accounts merely to satisfy short-term margin expectations on Wall Street.
The exchange between the analysts and Flournese on this specific topic was incredibly revealing to me.
Oh, it was a masterclass in long-term thinking.
Yeah. An analyst essentially asked, your demand is surging and your reliability is unmatched. Why not flex your pricing power and force the customer to absorb the inflationary cost?
And Flournese countered by explaining the lifetime value of the customer.
Right. He said, if you squeeze a key account on price during a volatile macro environment, you fracture the trust that anchors the whole FMI moat.
You basically give the procurement manager a reason to issue a new request for proposal to your competitors.
Which is the last thing you want. It is the ultimate display of capital discipline. They are protecting the long-term relationship over the quarterly spreadsheet.
Exactly. And management maintained their long-term modeling, projecting that as they sustain double-digit top-line growth, incremental margins will eventually return to the mid-20s.
And where are they sitting right now?
Currently, they are hovering around 21.5%, primarily due to that inflation gap and the fact that they distributed substantial performance bonuses this quarter.
Oh, bonuses.
Yeah, which actually indicates the internal sales force is successfully hitting really aggressive growth targets. So it's a good problem to have.
That is a great problem to have. We also need to address the capital return strategy. Flournese openly discussed advocating for a dividend increase.
Right, returning cash to the shareholders.
He specifically mentioned pushing the CFO to target an implied $1 per year payout as the stock approaches the $50 threshold, which would sustain roughly a 2% yield for investors.
That perfectly illustrates their capital allocation hierarchy.
Which is?
First, fully fund the internal operations where the ROIC sits in the low 30s, because that's your best return. Second, fortify the balance sheet. Third, return the surplus cash to shareholders through reliable, growing dividends and selective share repurchases to offset equity dilution.
It is just a highly predictable compounding formula.
It really is.
All right, this leads us to the final analysis. The bottom line. We have dissected the headline anomalies, the logistical mechanisms of their private trucking fleet, the psychology of their smart bins, and the strategic directives of the new CEO.
We've covered a lot of ground.
We have. So synthesizing all of this data, what is the actionable takeaway for a retail investor evaluating Fast today?
Well, based on the structural evidence in these transcripts, the outlook is highly bullish.
Highly bullish. Okay, why?
To truly appreciate Fastenal's performance, you have to contextualize it against the broader macroeconomic landscape. The industrial economy is not experiencing a supercycle right now.
No, management characterized the environment as just modestly positive.
Right. If you look at the U.S. PMI, the Purchasing Managers Index, which tracks prevailing manufacturing trends, it is hovering just above 53.
And a reading over 50 indicates expansion. So 53 signals an economy that is merely grinding forward at a very slow, cautious pace.
Exactly. Yet against that backdrop of a sluggish, cautious manufacturing sector, Fastenal is delivering 15% to 20% growth rates.
That is the defining insight of this whole deep dive, honestly. When the broader market is expanding by low single digits and a single company is growing by 15%, they are not just floating on a rising macroeconomic tide.
They're aggressively capturing territory from their rivals.
They are leveraging their reliability, their dedicated trucking fleet, and their localized inventory to win massive new contracts and embed themselves deeper into existing facilities.
So the actionable conclusion for you, the listener, whether you hold this equity or are considering a position, is this. The transition from Flournese to Watts is rooted in total continuity.
The key account strategy is mathematically validated by the data.
Right. The actionable advice is to look past the algorithmic Wall Street sell-offs triggered by a 75 basis point dip in gross margin.
Focus on the absolute profit dollars and the underlying mechanics instead.
Exactly. A business capable of absorbing commodity inflation, intentionally sacrificing gross margin to monopolize massive manufacturing accounts, funding significant internal bonuses, and still expanding its operating margin while generating hundreds of millions in free cash flow.
It possesses an incredibly resilient architecture.
That's the bottom line.
They are demonstrating a masterclass in operational efficiency in a highly mediocre economic environment. We have unpacked the data, explored the logistics, and examined the leadership strategy driving this incredible cash generator.
The evidence points to a company that understands exactly how to utilize its localized footprint to completely dominate a fragmented industrial supply chain.
As we wrap up this analysis, I want to leave you with one final provocative concept to evaluate on your own.
Always good to have some homework.
Exactly. So we just established that Fastenal is operating with peak capital efficiency, generating record cash flows, and posting 20% monthly growth spikes, while the global industrial economy is merely grinding along at a PMI of 53.
A very lukewarm environment.
Right. So what happens to the velocity of this business, their operating leverage, and ultimately their valuation when the global manufacturing sector inevitably enters a genuine supercharged expansion cycle?
Well, that's a great question.
If they're capturing this much market share in a sluggish environment, how much cash will this machine generate when the macroeconomic tide actually rushes in? Thanks for joining us on this deep dive.